want to give you an overview of the accounting for tax effect question that was done in the workshop session. In that question, it provided ABC company's assets and liabilities, carrying amount and the tax base at 30th of June 2011. So what you see here in the column carrying amount is the accounting values, and then the next column the tax base, that is the equivalent of the tax carrying value, which is called the tax base, in the right hand side of the column. So these values are given to us as 2011 at 30th of June. Then we are also provided with the 30th of June for the year ending 30th June 2012 statement of comprehensive income. In that statement, we have revenue, cost of goods sold, depreciation expense, and other expenses, warranty and doubtful debts expense, and other expenses, and then profit before tax. Then end of 2012, we are given the values as it appears in the statement of financial position. So they are the values that appears on the balance sheet. Then we are provided additional information. The first one is the plant is depreciated over 6 years for accounting and over 4 years for tax. Straight line method is used. And then it also tells us no amounts were paid for employee benefits during the 2012 year. Then it tells us there were no plant that was acquired during the year, and the tax rate is given to us as 30%. So part A requires us to calculate the temporary differences at 30th of June 2012 and state whether each of them is deductible and taxable. So now I'll take you to the solution. In this solution here, I'm going to now expand this. See here, accounting base of the plant is 3,000. It is after deducting accumulated depreciation. Tax base is 1,500. That is after deducting accumulated depreciation for taxation purposes. Then accounts receivable. It is 900. That is the carrying value of account receivable after deducting provision for doubtful debts, but for tax base, but the tax base is 1,400. That is before deducting provision for doubtful debts, because provisions are not allowed for taxation purposes. Then provision for warranty, it is 4,000 for accounting, and the tax base of that is 0, because unless and until the provision becomes deductible, is paid, it is not allowed for taxation purposes. Provision for employee benefits again is 3,000 for accounting, and the tax base is 0 because provisions are not allowed as deductions for taxation purposes. So what we see here is here's an asset. So it looks like ABC company is richer than what it thinks, what the tax office is thinking. That means the company will have to pay taxes in the future. So this difference, that temporary difference, is called a taxable difference, because in the future company will have to pay more taxes. Accounts receivable, here's an asset, but the asset value is lower. Looks like company is poorer. The company is poorer, then company will have to pay less taxes in the future. Then the difference is called a deductible difference, because in the future company will be saving on taxes. Provisions for warranties. Provisions for warranties, here it is 4,000, but the tax base is 0. Looks like with provision, more provision, that is more days, company is poorer. The company is poorer with more dates, then it will have to pay less taxes in the future. So it becomes a deductible difference. Again, provision for employee benefits. Provision makes the company poorer, debts increase. If the company becomes poorer, it will be paying less taxes in the future. That difference is called deductible difference. So if you go back to the part B of the question, is asked, calculate the balance of deferred tax liability and deferred tax asset at 30th of June 2011. So I go back here, I take all the deductible differences separately, and deductible differences will lead to deferred tax asset at the tax rate, and the taxable differences will lead to deferred tax liability at the tax rate. So we take the differences. 1,500 is the taxable difference, all others are deductible, and 30% of that is 450. That becomes a deferred tax liability, because it's a taxable difference, deferred tax liability. So our entry would be debit income tax expense 450 and credit deferred tax liability 450. And then we take the deductible differences. We add all the deductible differences here, and when we add them, it equals to 7,500 at 30%, 2,250, and if we take the tax portion, that becomes a deferred tax asset, debit deferred tax asset 2,250, and credit income tax expense 2,250. Then part C is asking us to calculate ABC Limited's taxable income for the year ended 30th of June 2012. So let's look at the taxable income calculation now. So to calculate taxable income, we start with the profit before tax. We have the profit before tax, but then anything that is not deductible, that is not allowed for taxation purposes, we will put it back. Anything that is allowed for taxation purposes, we will deduct. If it is an expense, tax deduction. If it is assessable income, we will add it. So let's go one by one. Accounting depreciation, not allowed for tax, we put it back. Tax depreciation expense, that's allowed, we deduct. So this is for the 2012 year. We are now looking at the expenses and the revenue, because we are trying to calculate the taxable income, not the deferred taxes. We are calculating the taxable income. And warranty expense, not allowed for taxation purposes. We put it back. Warranty paid, we will deduct. Then employee benefits, included in other expenses, 50. That's given in the notes. And we are not told we are told that there's no deduction, so there's no deduction for tax purposes. There's no payment of employee benefits during the year, so there's nothing to deduct for taxation purposes. Doubtful debt expense, that's not allowed for taxation purposes. We put it back, we reverse it. Debts written off, we will deduct 400. And then when we add all this, it gives us the taxable income, the amount on which the tax payable will be calculated, 150. And 30% of that is 45. So tax payable, credit 45, and debit income tax expense 45. Now you might ask, how did I get this warranty paid? 2,800. This is how I got it. Provision for warranty at the beginning of the year is 4,000. Then when we had the expense, we increased the provision for warranty. We credit provision for warranty and debited expense, debit expense, 800. That is that 800 that we got from here, 800. And then total of that is the total of that is 4,800. Warranty paid in cash is something that we don't know. But what we know is provision for warranty costs that is given in the question is 2,000. So 4,800, but it became 2,000. Ultimately, it became 2,000 because 2,800 was paid as warranty costs. That decreased the provision. So that's how I got 2,800. Then Part D. Part D is asking, calculate the amount of temporary differences at 30th of June 2012. So Part A, we calculated temporary differences at the beginning of the year. Part D, now we are calculating at the end of the year. So here it is. We now list all the accounting carrying values and the tax basis. The planned, the net value is, the carrying value was 3,000 and there's additional depreciation during the year 1,000. The carrying value is 2,000. For taxation purposes, carrying value was at the beginning of the year 1,500 and the tax depreciation was 1,500. Therefore, the tax base now is 0. The difference becomes a taxable, a temporary difference because accounting basis more company looks richer. That means it has to pay more taxes in the future. Accounts receivable is 1,500 minus provision for doubtful debts 1,350. But provisions are not allowed for tax and the tax base is 1,500. Therefore, that difference is a deductible difference because the carrying value is less than the tax base. Looks like company is poorer, less assets. That means it will be paying less taxes in the future. So that difference will become a deductible difference. Provision for warranty costs. The debts are more, provision is more, tax base is 0 because provisions are not allowed for taxation purposes. If company is poorer, more debts there, it will be saving on taxes in the future. and that difference is called deductible difference. Provision for employee benefits 2,500 is the difference is called deductible difference. Company looks poorer. That means it will be saving on taxes in the future. Again, we separate out the taxable differences and deductible differences. So I take the taxable differences, 30% of that becomes a deferred tax liability, 600. And then the deductible differences, when I add it up, 4,650, 30% of that is 1,395. What it says is, at 30th of June 2012, these should be the balances. But at 30th of June 2011, we had some balances for deferred tax liability and also for deferred tax asset. So now we have to determine whether the balance increase or decrease. So we look at this and we see here deferred tax liability is 600 now, but it was 450 2011. So the increase required is 150. And then the deferred tax asset, the increase, the amount is 1,395, and the 2011 it was 2,250. So the difference here is 1,395 minus 2,250. It is 855. 855. It's a decrease. So now we have to decrease that difference, and we have to increase the deferred asset. For the deferred tax asset, we have to decrease the difference. For the deferred tax liability, we have to increase the difference. So here it is. Deferred tax asset we are decreasing 855, and debit income tax expense 855. Deferred tax liability we are increasing by 150. Now the income tax expense and tax payable we found out in 2012. We calculated it is 45 and 45. So that is also an entry in 2012. Part G. Prepare journal entries to record current tax and deferred taxes, assuming there's a loss of 500, not 2,500. So all we have to do is we have to now find out the taxable income. Earlier it was 2,500 profit, but now it's a loss 500. Here's that loss 500. We start with that. Everything else is same, and we end up with a tax loss of 2,850. So for the tax loss 2,850 into 30% becomes the deferred tax asset. Here's the deferred tax asset 855, and credit income tax expense 855. Deferred tax asset, I have said here deferred tax benefit, so it is deferred tax asset, and the other side is income tax expense 855, debit and credit.